Hey there, and welcome. Today we're going to jump right in and tackle something that, let's be honest, can look super intimidating: stock market indicators. The goal here? To break them down into simple, powerful tools that you can actually understand and, use. So, let's get into it. You've been there, right? You open up a stock chart and bam, it's just a screen full of squiggly lines, blinking numbers, and all these graphs. And you're probably thinking this exact same thing. It can seriously feel like you're trying to read another language. But trust me, by the end of this, it's all going to make a whole lot more sense. So what even is an indicator? Well, the absolute best way to think about it is like your car's dashboard. I mean, your speedometer tells you how fast you're going right now, but it doesn't predict you're about to hit the gas, right? Your fuel gauge shows you what's left in the tank, but it doesn't magically create more fuel. Stock indicators are exactly like that. They give you useful information based on what's already happened.
And that brings us to what is maybe the most important rule of all. Indicators are just tools. Really helpful ones. They process past price info to give you a clearer picture of things. They're all about helping you make smarter, more informed decisions, but they absolutely do not predict the future. Think of it this way. They're about probability, not prophecy.
All right, let's meet our first tool. This one is probably one of the most fundamental and widely used indicators out there. It's the moving average, or MA for short. I like to call it the trend spotter because, well, that's its main job, to help you see the big picture trend.
So how's it work? A stock's price can be really jumpy from day to day, right? It goes up, it goes down. We call that noise. The moving average just smooths out all that noise. It creates a single, flowing line that shows you the average price over a certain time. And that makes seeing the real, underlying direction, the trend, way, way easier.
And reading it couldn't be simpler. There's really just one basic rule here. If the current price of the stock is trading above that smooth line, the general trend is considered up. If it's trading below the line, the trend is down. That's it. It's your first quick glance at the market's overall mood. Okay, let's move on to our next tool and see how these things start to build on each other. This next one helps us figure out let's call it the intensity of a price move. It's called the Relative Strength Index, or RSI. But a much better name for it? The price thermometer. The RSI is what's known as an oscillator. That just means it moves back and forth inside a range, in this case, between 0 and 100. Its whole job is to measure the speed and the change of price moves. Basically, it's telling you if a stock has gone up or down maybe a little too fast and might be due for a break or even a reversal.
So, here's how you read this thermometer. If you get a reading up above 70, that suggests the stock is overbought. It's gotten a little too hot and might need to cool off. On the flip side, a reading below 30 suggests it's oversold. It's gotten too cold and might be due for a bounce. Now here's a really crucial point. A stock can stay too hot or too cold for a long time. So think of this as a warning sign, not a command to immediately buy or sell.
Okay, our third and final tool has a bit of a scary sounding name: Moving Average Convergence Divergence. Yeah, let's just call it the MACD, or even better, the momentum gauge. Don't let that long name freak you out. The idea behind it is actually pretty simple.
The MACD is all about one thing: momentum. It helps you see if a trend is picking up speed or if it's starting to lose steam. It's made up of two lines, a faster line and a slower one. And it's the relationship between those two lines that gives us all the juicy signals.
Probably the most common way to use the MACD is just to watch for something called a crossover. So when that faster, more twitchy line crosses up and over the slower line, it's seen as a bullish signal, a potential sign to buy, because upward momentum is building. And you guessed it, when that faster line crosses down below the slower one, that's a bearish signal, a potential heads up to sell, as downward momentum is taking control.
All right, we've met our three individual ingredients: the trend spotter, the price thermometer, and the momentum gauge. But just like with cooking, the real magic happens when you start combining them. So now, let's put it all together into a really simple three-step recipe. Let's just imagine for a second you're thinking about buying a stock. Instead of just relying on one signal, you use this checklist. Step 1, check the overall trend with the moving average. Is the price above the line? Yep, cool, that's a green light. Step 2, check the temperature with the RSI. Is it below 70, so it's not totally overextended? Perfect. And step 3, check the momentum with the MACD. Did those lines just cross over for a buy signal? Check. See, when all three of them line up, your confidence in that decision just goes way, way up.
And just like that, you've gone from looking at a confusing chart to having a clear, organized toolkit for your analysis. You now have 3 different tools that each tell you something unique about what the market's doing.
So let's do a super quick recap. You've got the moving average, that's your trend spotter, giving you the big picture. You've got the RSI, that's your price thermometer, warning you if things are getting a little extreme. And you've got the MACD, your momentum gauge, signaling when the power might be shifting from buyers to sellers or vice versa.
And this right here, this is the most important takeaway of all. These tools are at their most powerful when you use them as a team. Any single indicator can give you a fake out, a false signal, but it's a whole lot harder for all 3 of them to be wrong at the exact same time. Use them together for confirmation. That's how you build a stronger case for any decision you make.
So there you have it. We've turned that confusing mess of lines into a pretty practical toolkit. You now have a framework to look at pretty much any chart and at least begin your analysis. The learning journey never really ends, of course, but you've just taken a massive first step. So, now that you have your toolkit, which tool are you going to explore first?